Hello, today I want to talk about CAPM, or the capital asset pricing model again. I have some other videos out there you should check out. You can see them by following these links here. In the last one, I talk about some assumption problems with the model that very clearly don't reflect reality. Today, I want to talk about a less obvious problem with the model. As a refresher, kind of the obvious assumption problems are that all investors are perfectly rational, all investors are perfectly diversified, no investor, regardless of their size, can change the price of an asset, that everybody can borrow and lend at the risk-free rate, that everything is free transactions, taxes, etc. There are no frictions involved in your investing, that everything is perfectly liquid, everything is perfectly divisible, that all investors have the exact same assumptions regarding the price of an asset and what it's worth and what its returns will be and what its standard deviations will be, that all information, public, private, everything that is perfectly known immediately, freely to all investors. Now, clearly, a lot of these things are complete nonsense, but what I want to talk about is the distribution problem. So the model also assumes that asset returns are perfectly normally distributed. So that means the only two moments of the data that we care about are the mean and the standard deviation, okay? But it turns out not all data sets are perfectly normally distributed, okay? But this model says, yeah, look, we have to have zero skewness. We have to have a kurtosis, a normal kurtosis of +3, and that any kind of skewness, positive or negative, is not allowed, and any kind of kurtosis, is not allowed either. But it turns out that's not the case. So this would be kind of the distribution of stocks. It turns out there is this big negative skew we can see over there, which means there are a lot of negative returns that you wouldn't see in a normal distribution. In fact, I have a video about that. You can check it out by following this link here, where it says, like, basically, more than half of all stock returns end up being negative. You lose all your money essentially, okay? And that's just how stock market returns are. It also, if we look at kind of the kurtosis of the market, what we're going to see is positive kurtosis, which means that we're going to have this kind of this peaked center there, but we're also going to have these fat tails. We saw that fat tail kind of on the skew there. So these are going to be skewed towards the negative returns, but that's what stock market returns actually look like. Now, the ramifications of this are that this utility function that we think about in terms of rational utility maximizing investors, this doesn't really hold, that concave shape, it just doesn't work with this kind of real distribution. So this kind of goes out of there. If it's not normal, we're not going to have a concave utility function. Another problem here is that when we think about risk and return, those are only two moments, right? So return would be the mean that we think about, and risk would be the standard deviation. But in this whole framework, there's no mention of skew and there's no mention of kurtosis. So what that means ultimately is, if we're only focused on mean and standard deviation, we're ignoring the negative skew and we're ignoring the fat negative kurtosis tail, and we end up overpaying for assets because we're ignoring those two moments of the distribution. That is the big problem here, is that this really, from a statistical point of view, just doesn't quite add up. Anyway, hope you enjoyed that. Happy trading out there. I'm Brian Kozlowski. Thank you so much.